Good evening everyone, Christian Evans from Sanktuary here this evening, and today I'm going to do something a little bit different. I'm going to be doing a short presentation based on a recent blog post I've done called Social Trading is Not as Good as It Might First Seem. Now, I haven't been a fan of social trading throughout the entire of my career, and in this presentation, this video, I'm going to kind of give a few ideas as to why I believe that social trading is not the way forward. So we're going to go through a couple of slides. I'm not 100% sure how long this video is going to be. It might be split over two sections, but we'll see how we go. So first of all, it's important for us to have a look at what is social trading. So basically, social trading is, as a market, is a set of online brokerage firms. You might have heard them already: Darwinex, EToro, etc. All these big names that you see on online social media, Twitter, Facebook. They're all there with their advertising. Basically, it's like similar to like a trade copier, whereby your funds are actually technically managed by a money manager. However, it's set up whereby it's classed as a copier for kind of regulatory purposes there. So as we already talked, you invest in money managers. Now this is done through you open an account with one of these online brokerages, and then you select who you want to invest your money with. So you can either invest your money yourself as a trader, or alternatively, say you had three different money managers to choose from. You might choose one, two, or even all of them to actually allocate capital to. So if you invested £1,000 and the money manager made 20%, you would make 20% on your actual on £1,000 that you actually put to work with them. So the one benefit that is of social trading is the various amount of instruments that are traded. Now, there's quite a large scope for these money managers to be able to invest across a number of different foreign exchange pairs, shares, both UK, US and other international equities, commodities, gold, Brent crude oil, WTI crude oil, all these sorts of things, and also some of the fixed income products as well. So we've got quite a large remit there that you can actually select to trade. The other aspect they're supposed to do is it's based on education. So there's a lot of forums, a lot of discussions. You almost have like a Facebook where or more like a Twitter account whereby you can post your analysis and kind of comment on others and share ideas. Now that does sound good on the face of it, but however, I am going to point out later on a couple of reasons why it doesn't actually always pay dividends. It's all about the quality of the education that's actually being shared there. But obviously, on the face of it, a forum and discussion panel there looks quite a good thing for interaction. So as we said already, it's sold as a way to learn. It's there for you to be able to share ideas, gain a bit of knowledge, and kind of ease your way into the financial markets if you're not 100% clued up on it. So as we said, now we're going to try and provide a balanced approach here. Even though I'm going to say my opinions on what I think overall, it's fair for me to actually be presenting both the negatives and the positives to social trading. So the first one of these is that generally it is only performance fees that are payable when you select a money manager. So if you went in, you tend to only pay a performance fee based on the money that's generated. Now that's dependent on some of them. Some of them don't even charge a performance fee. So for example, if you put in the example we used, you put £1,000 with investment manager A, and they made 20%, you would get the full 20% there. Others might take a cut, but it kind of depends on the platform that you are using. And also, as we've already stipulated, the range of products that are available are quite vast. Now, there's a lot of the major and also some of the minor currencies that you can actually trade there. So for some of those that like to take a little bit more risk, perhaps in more of the illiquid instruments, obviously foreign exchange is heavily traded anyway, but relative to the dollar, yen, the cable, those sorts of pairs, they can be deemed more illiquid in nature and will tend to have wider spreads there to reflect that. The flexible investment amounts, you can open an account with as little as £50 I've seen, or $50 for those of you in the US. They kind of structure them the same. So you can actually get exposure to the financial markets with a very small amount of money, and that's because, like most of the platforms that are offered to retail clients these days, they are using high volumes of leverage and a margin trade in it for you to be able to get that exposure. And also have the ability to make money off that. I mean, people aren't going to be enticed from turning a £50 account into a £55 account over a year, which, you know, represents a 10% return. They're interested in trying to turn £50 into 50,000. So that selling aspect of it kind of feeds in as a benefit for these providers of these accounts. And also, as we said, the accounts are supposed to be very interactive. You have your own account, you have your photo, your profile. You're able to discuss your analysis with other people, share ideas, learn, and so forth, and also comment and post almost like tweets there. But it kind of, especially on eToro, you can post just general short snippets that you want other people to know about. So this is basically going to be the focus of my analysis in terms of the drawbacks of social trade, and I'll go each of these in turn. But basically, the use of leverage, the way in which most traders use leverage is often overstated. They use ridiculously high leverage, which can lead to drastic returns or exceptional returns, depending on how you look at it. Today, personally, I had a look on Twitter at some of the accounts that are following, some of the people that are following me, and it's unbelievable because I like to follow people that are in the same sort of industry as myself, so other traders, so we can share ideas and kind of interact with each other and learn and continue to learn. Nobody is perfect. Even the Warren Buffetts of the world, including Warren Buffett, profess to read daily and kind of continue to strive to learn. So the amount of leverage there, professionals who operate in hedge funds will tend to use leverage, but they will not use more than 5 to 7 times. However, with these social trading accounts, I have seen some of them which allow you to use up to 100 and even 500 leverage. That is a massive, level, and some of them don't actually provide negative balance protection, which is an important aspect if you're trading and you're quite inexperienced. You need to be able to have the protection that. So there were examples of the part-time traders. I think there was one who was a teacher who got on the wrong side of the trade when the Swiss franc in January 2015 was unpegged, and he had a bill of £280,000 that he owed his brokerage. Fortunately for him, they wiped it off as a kind of an act of God, and the companies kind of took the losses there. But that's quite an important aspect there. You need to have that negative balance protection there, but they don't always offer it. Also, the account size. Now, if you went to invest £1,000 in Money Manager A, you don't know how much money they are managing. You also don't know the amount of money they have in their account. So if you invest £1,000, traditionally, if you were going to invest, say, that £1,000 into a investment fund, a mutual fund, a hedge fund, anything like that, obviously a hedge fund kind of a bit too low there, but any of these investment products, you would actually have a rough idea about the size of the fund in which you're investing in. Now, because it's a trade copier, all that's going to happen is your level of trade sizing is going to be mimicked, so to speak, in terms of the account, the master account being used. So, for example, it kind of adds a bit of a lack of openness and a lack of transparency. So, if you were to invest £1,000 into Money Manager and he only had £100 in his account, and he was kind of playing the markets a bit recklessly with high margin, then you stand to lose 10 times the amount that the actual money manager has to lose. So it's all about having skin in the game there. If you invest £1,000, you would look for someone to be managing, £50,000 to £100,000. So you're kind of making up a piece of the puzzle, so to speak, and not making up more than what the puzzle actually is. So that's an important thing to know. It's all about having that openness and transparency. It's all about having that way of knowing who the person is that's actually kind of in charge of your destiny, who's taking those trades, why are they taking those trades, and you don't really get that from these social trading platforms. Also, another thing to note is the ease at which people can get involved in these social media or social trading platforms. There's no barriers to entry, just like we've had the boom now in spread betting, CFD trade, and all these risk-free sort of trading. People are taking it in, in their own backs, low interest rates. They're moving away from the cash ISAs that they're looking to try and do it themselves, and they're looking to do it tax-free through those products and services there. However, the stats show 95% of traders and investors consistently lose money. Now, the fact that you haven't got any barriers to entry to these social trading platforms, and the fact that they're then able to manage other people's money, adds a bit of a threat. The percentages are against you. If you had, say, £5,000 and you wanted to diversify across 5 different money managers, there is no guarantee across any investment anyway, but they don't have that sense of accountability. The percentages against you can actually have a higher probability of that investment being totally lost, needless to say, partially lost, from investing in these money managers who are not regulated, who have not got no track record, and have not even got a face-to-face way of interacting and actually understanding what they're all about, how they trade, and anything about them. It's very much a punt in that sense. I've seen accounts whereby, relating to the account size that we just spoke about, where trade copiers have made thousands upon thousands of pounds in a week, whereby a trader has literally doubled or trebled his account overnight, purely because the account size is tiny. On the flip side, you also see it then where those highly leveraged accounts, which are ridiculously high in profit, people haven't banked those profits, where the accounts are blown the following day. Now that's going to be heartbreaking if you turned £1,000 account into £3,000 or £5,000, and then the following day it's no more, so to speak. But that's the risk involved. People don't understand the true risks involved with these social platforms, and the percentages against you, and the fact that you are looking into a market where 90 to 95% of people are not going to make money. You have therefore got to be picking the creme de la creme to make money, and it's almost like stock picking. It's stock picking of money managers. There's no barriers to entry. There's no way of kind of building a rapport and a relationship with the people who are looking to invest in you, and that poses a massive problem going forward. Another thing to note is that these people are going to be trading your capital, and the eToro, the Darwinex, they know that people aren't essentially clued up when they use these platforms. They're not necessarily the professionals that are going to be managing large amounts of capital. So based on the fact that they know that there's no barriers to entry and they have a high demand, they're in the position where the professional softwares, etc., are out of the realm of the people who are going to use these social trading platforms. They're going to be small players in the market,